14 of 21 series are aligned with a stagflationary configuration this morning. That is a moderate but meaningful degree of agreement across the 21 series the framework monitors. The current macro regime is stagflation mild, with a confirmation score of 14 out of 21. In the framework's language, stagflation mild describes a macro regime where growth momentum is decelerating while inflation momentum is accelerating at the same time. The engine's growth composite is negative, at roughly minus 0.19 on its normalized scale, and the inflation composite is positive, around plus 0.01, capturing that combination of softer activity data and firmer price pressures. The coherence score sits in a moderate band, and the confirmation score of 14 out of 21 indicates that a clear majority, but not an overwhelming supermajority, of the 21 series agree with this reading. By the engine's historical math, regimes with a similar confirmation score held in roughly 41% of observed cases over rolling 3-month windows, with the most commonly observed next state being a shift toward an acceleration-type configuration in the internal taxonomy, a description of past transitions, not a statement about this one. Compared to last week, confirmation has stayed in that same middle range rather than collapsing or surging, while the growth composite has nudged more negative and the inflation composite has edged slightly higher. Historically, environments that looked like this under the framework have often felt like grinding markets. Broad equity indexes made uneven progress. Defensive sectors and real assets held their ground more consistently, and cash and high-quality bonds played a more visible role, a record of past behavior, not guidance. On the yield side, the 10-year Treasury note yields about 4.55%, with the 2-year near 4.13%, leaving the curve modestly positively sloped. The framework classifies the long end as green momentum, which it defines quantitatively as a positive recent total return profile with volatility that is stable or cooling relative to the prior window. Investors watch this part of the curve as a read on long-term growth and inflation convictions, and on how restrictive policy feels in real terms. The question it raises for both institutional and individual investors is whether a gently positive curve alongside this stagflationary reading changes how much duration, credit, or equity risk they are comfortable carrying. In our framework's reading of comparable periods, this roughly coincided with high-quality government bonds holding their value more often than not over the following few calendar quarters, while risk assets saw more dispersion, an observation under our methodology, not a forecast. What would challenge this interpretation is a decisive move higher in shorter-dated yields that flattens or inverts the curve again, or a sharp drop in long yields that signals a more abrupt growth scare. On the labor side, the engine's non-farm payrolls and related employment indicators sit in the red momentum zone. Red, in this context, means the composite of hiring growth, hours worked, and jobless claims is decelerating on the engine's rate of change math, even if levels remain historically healthy. Markets follow these labor readings closely because they anchor the income side of corporate revenues and consumer spending, and they influence how central banks weigh inflation against growth risk. The question that emerges is whether a cooling but not collapsing labor market validates current equity and credit pricing or challenges it. In our framework's reading of comparable periods, this roughly coincided with wider dispersion across sectors and factors over the ensuing months. Stronger balance sheets and more defensive earnings profiles tended to hold up better. A record of past behavior, not a forecast. A re-acceleration in hiring or a renewed drop in jobless claims would challenge the current red momentum read. Credit spreads are the third signal. The framework's composite of corporate bond spreads over treasuries, particularly in high-yield and lower investment-grade segments, has stayed contained rather than breaking wider, which the engine tags as yellow momentum. Yellow means spreads are neither compressing aggressively nor blowing out, and the path of daily changes is choppy rather than trending. Investors and lenders follow this closely as a real-time referendum on default risk and funding conditions. The question they often ask in a backdrop like this is whether stable spreads are underpricing macro noise, or whether they reflect genuine resilience in corporate balance sheets and cash flows. In our framework's reading of comparable periods, This roughly coincided with credit total returns that were more stable than equities, but still subject to episodes of volatility when macro data surprised. An observation under our methodology, not a forecast. What would challenge this read would be a sustained, multi-week widening in high-yield credit spreads that pushes the composite into clear red momentum. For a fourth signal, look at equity sector behavior. Technology, a proxy for higher growth and longer duration cash flows, is down more than 2%, while healthcare, utilities, real estate, energy, and materials are all positive on the day. The framework marks technology as red momentum and several defensive and real asset sectors as green. Investors watch this pattern as a barometer of how comfortable markets are with long-duration growth narratives versus near-term earnings stability and tangible assets. The question this raises is whether the shift away from high-growth sectors toward defensives and real assets is a brief rotation or a longer stretch of more cautious positioning. In our framework's reading of comparable periods, this roughly coincided with stretches where those defensive and real asset areas, including parts of energy and materials, saw steadier relative performance over subsequent weeks. Again, a record of past rotations, not a forecast. A renewed leadership swing back toward technology and other cyclicals, confirmed by breadth and volume, would challenge this configuration. Turning to the conditional map, the engine is tracking two if-then thresholds. If the 10-year Treasury yield crosses 4.45% and holds there for 5 consecutive sessions, in our framework's reading, the inflation composite showed acceleration in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. Under a stagflationary macro regime, such a move would simply be logged as a stronger mathematical case for an expansion to acceleration type transition in the history. If the fear and greed index on broader markets drops below 15 and holds for 5 consecutive sessions, in our framework's reading, confirmation scores deteriorated in roughly 7 of 9 comparable conditions. Again, a historical characterization, not a forecast. In a backdrop like today's, that would be recorded as a weakening of regime confidence, not as a directional market call. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework, price structure, rate of change, risk regime, and market participation, across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, Atlas records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols. The 4 layers do. Members use Atlas to study how the framework has recorded conditions across prior environments as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what to do next. The entire Atlas process is framed as potential, and educational in nature, intended to help investors analyze data, not to prescribe actions. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.